Would you be spooked if they indicated a greater concern about an employment market that you say is leaky?
I think that would be a welcome acknowledgement of what we've seen in the labor market data, whether it's the unemployment rate, now up 0.7% from the low, or when we look at the JOLTS data and the hiring rate has dropped and the quits rate has dropped. So there's some softening going on there.
If they've got unemployment year-end at 4%, what's your underlying assumption, your base case for the labour market by the time we get to September, by the time we get to year-end?
I think the unemployment rate goes a bit higher. I think you have to appreciate the policies that are in place today are restrictive. We're at 5 3/8% Fed funds rate. So that's brought growth and inflation down a lot. You can't just leave them there. And by the way, just bringing rates down 25 basis points, I don't know why the Fed is getting so wound up about that. They're just going from very restrictive to very restrictive minus a teeny bit. They're still in restrictive space.
I asked the unemployment question because I'm trying to work out whether this is truly a fertile environment for risk assets or not, and whether it will be by the time we get to September, October, November, December. If we're leaking oil now, where's the engine? What does the vehicle look like by the end of the year?
It's a Maserati driven by the FOMC with Fed in the driver's seat. And this is...
Should I be comfortable with that?
I don't know. You can look at that however you like. I tried to pick an Italian car for you.
I know
you appreciate that. But listen, this is 95 again, where things look pretty shaky, but they took pressure off of businesses and households and started to bring the Fed funds rate down. We're in a soft landing. 4.1% unemployment isn't 5.1% unemployment. It's leaking the wrong way, and they probably want to start pulling that down right now, or at least stabilizing things where they are. You can start doing that with series of 25 basis point rate cuts. They have that power.
At every single meeting for quite a while. That's some of the calls that we've been hearing about. What have you adjusted how much you think the Fed's going to have to cut rates to deal with the leaky engine in the Maserati that John is driving to the Fed's decision later next year?
I don't think as much as the market thinks. I think we're probably looking at, I don't know, 75 to 125 basis points. I don't think this is 200 to 300 basis points, which is what they've done in the past, because I don't see recession. I actually see that there's still a lot of money sloshing around from the fiscal programs. It's still being tapped by state and local governments. They're spending it, they're hiring, and that's creating economic activity.